Welcome and thanks for joining today. This is a webinar in support of our recent publication, The First 50 DRRs, which looks at initial trends from the current AGM season. I'm James Harris. I'm a Managing Director in A&M's Exec Comp Practice, and I'm joined today by Alex Gardner, a Senior Director in the team. We're going to be looking at trends from the season in terms of salary. We're going to look at some of the new remuneration policies that have been proposed. We'll look at changes, increases to incentive opportunities and also incentive outcomes. And we've got a piece, some small pieces on ESG, windfall gains, share and net fees. So we've got a lot to get through. If you want to ask a question anytime through the webinar, we'd love to have them. You can do it in two ways. You can use the chat function. And if you want to submit a question anonymously just to us, you can use the Q&A function as well. So please do, and we'll hopefully leave some time at the end for questions as well, but submit them as and when we're going. And the session is recorded. We will be distributing a copy of the recording and the slides after the session. So our publication is the first 50, and it looks at the first 50 DRRs that are published in the season, September to December year ends. And what we do is we cut that off at the 11th of March and get that out as soon as we can to you. We know you want the earliest trends possible, so we cut that off, and that's when that goes out. We published the report in late March, but of course we know that you want the very latest data. So what we've done for the purposes of the webinar is we've expanded the sample by adding the next 50 DRRs that got published to our first 50 DRRs. So we're talking about the first 100 DRRs that were published in the season. And the chart there shows the publication dates of the annual report. So I just wanted to pay tribute to the team, to our team, for the great work they've done in pulling together. As you can see, after the cutoff for our publication, a lot of DRRs then flood in, and they've managed to go through and analyse all of those for the purposes of today. So thanks to the team. And again, just to confirm, we're talking about the FTSE 350 here. So broadly evenly split in the sample between 100 and 250. So let's start on salary increases. And we'll start with the average employee increase that we've seen. Again, it's a useful reference point for setting executive salaries, is what's going on in the business. And of course, for many years, all employee rates were 2 to 3% very consistently in the UK. Last year, we saw a big spike in all employee rates as a response to the inflationary environment, the cost of living environment. And what we've seen this year is a reduction in the all-employee rates. So you can see on the slide, 2/3 of companies in the sample have a lower employee increase this year than they did last year. But despite that, the all-employee rates still remain above that previous long-term average at 2 to 3%. So the median last year, 6%. You see in the chart on the right, that's fallen this year to 4.5%. And the other thing that we've seen is, again, reflecting the change in the inflationary environment and the cost of living environment, is much fewer disclosed use of one-off awards to one-off payments, one-off awards to employees. So in the sample, last year, over 40% were disclosing some form of assistance of payment. That's down to less than 10% this year. So that's what's going on with the all employees. And then how about the relativity with executive directors? So again, for many years, when the all-employee rate was 2 or 3%, it was very common that you would align your executive increase to the all-employee rate. That was very common practice. And then last year, when the employee rate spiked, we saw lots of companies discounting the executive director increases relative to the all-employee rate. So if your all-employee rate was, say, 6%, you might do 4% for your executive director, something like that, some discount to the all-employee rate. And what we've seen this year, so despite the all-employee rates coming down a bit, discounting is still the most common approach. So over 60% of this sample discounted the executive director increase or the CEO increase relative to the workforce rate, which is down from 85% last year for discounting. And what's interesting is companies are more likely to do that if the all-employee rate remains higher. So you can see that on the chart on the right-hand side. So what this chart shows is each of the bars is one company in the sample. The bar itself shows the all-employee rate, and the marker, the little dot, shows the CEO increase. So you can see, at lower levels of increase, so when you're doing 3% or 4%, even 4.5%, it's relatively common to align the executive increase with the all-employee rate. Once you go above that, once you're into sort of 5, 6, 7%, it's much more common to still use some kind of discounting. And there's a handful that you can see in the chart there, and both charts, that only a small proportion putting increases through above the employee rate. So that remains relatively uncommon. There are a handful in there, citing competitiveness of the package, performance of the individual, and generally most of those companies in that group that put the salary above the workforce rate got secured, from what we can see so far, support from ISS, support from their shareholders for the DRR. So if you translate all that into what's actually happening at absolute level on executive increases, the rate remains broadly unchanged. So the median increase for the CEO, median increase for the CFO, 4% unchanged from last year, which kind of makes sense in the sense that all employee rates are coming down, but fewer companies are discounting to that rate, and that sort of comes out in the wash. How to interpret the trends on salary is interesting, because it did used to be almost mechanical. Back in the 2 to 3% days, it was almost mechanical for lots of companies. Very, very simple. Let's just align. That was obviously changed last year with this trend towards discounting. And I think we're probably in something of sort of uncharted territory here as to how this will play out looking forward. We don't expect 4% to stay as the new normal for executive rates. There's still going to be this need to look at the all-employee rate and ensure you have an appropriate relativity to that all-employee rate. But I think it's probably one where committees will want to really stay abreast of how salary developments continue, because if you're a company that's been aligning with your workforce at 2% or 3% during the last couple of years, if you re-benchmark, you might suddenly find that there's a large part of the sample that have been doing 4%, 5%, and the salary might start to look less competitive. So I think it's one to monitor and keep on top of how this continues to develop. Next, we'll get into remuneration policies. We have 30 new policies this year in our sample, so about a third of the sample. And of course, the policy proposals this year take place in the midst of this ongoing so-called big tent debate around the competitiveness of the UK remuneration for executive directors. Is it too restrictive? Is it too homogenous, inflexible? Is it not competitive enough from a quantum perspective? And so what we're trying to do here is identify if there are any early themes of companies responding to that debate, which of course you have to take with a bit of a pinch of salt, because obviously a lot of these policies would have been in development, in consultation, a year ago. So before the IA letter, before the CMIT letter, even before A&M's Big Ten publication, which was June last year. So I think some interesting things here, but as early themes, but we need to just keep in mind that there's still a long way to go in that debate and how the market responds. So the first slide here is about incentive structure. We've got about a quarter of new policies changed the structure. And what we might expect long term as a consequence of the Big Ten is a bit more flexibility, a bit more moving away from the UK norm to something that's a bit different, a bit tailored to the company or its markets. We have, in terms of what we have actually seen, it's a bit of a mixed bag. So if you look at those top 4, what we've got there is companies moving the other way. So moving from something which is slightly more unusual to the standard PSP, which is interesting in itself and showing that you don't want to throw out PSPs. They may well continue to be really appropriate for a large part of the market. So it's always good to be, I think, reminded of that. And then halfway down, we do get a bit more variation. So we've got two very interesting examples there of companies moving from a PSP to a hybrid, so-called hybrid, which is a combination in both cases here of PSP, performance shares, and restricted shares, so the same but without performance conditions. Now, in both cases, ISS have recommended against those proposals, but we think that is really a consequence of the fact that not only were the company moving the structure to a hybrid, but they were also increasing the quantum. We'll come back to increasing quantum, but we think because it would be slightly disappointing if we were to conclude that hybrids are not going to be acceptable. I think there's a lot of the market out there thinking that they might want to explore that route, and I think here it's too early to tell whether ISS are likely to be supportive or not, because I think the recommendations here are largely driven by the quantum aspect of it. And we also have a couple of companies moving away from PSPs, RSUs, to a single incentive. So some interesting initial trends there. Then we get into another structural feature. Around a quarter of the new policies have softened their approach to bonus deferral. So the most common way in which that's done is that they have reduced the amount which must be deferred. And that's shown in the chart there. So each bar is a separate company. You can see what the previous level of deferral was as a percent of the bonus, and then what that's come down to. And interestingly, the most of those, the companies on the left-hand side, they have made that conditional on whether you've achieved your shareholding guideline or not. So, before you've met your shareholding guideline, if you look at the first company, you would have to defer 50% of the bonus. But once you've met your shareholding guideline, that then comes down to 25% of the bonus. So it's an interesting new approach, and it's interesting that quite a large part of our sample seems to have adopted that approach, which is, of course, highly relevant from a Big Tent perspective. So we know that one of the big themes in the Big Tent is, lots of the provisions and the safeguards that have arisen in the UK market around to foster sort of share ownership, long-term alignment with shareholders. Deferral is one of them, but holding periods, shareholding guidelines, all have in isolation a good rationale, solid rationale for them. But what we're thinking is that once they're combined, in aggregate, they start to have, as the IA, as we put on the slide, as the IA has recently said, a disproportionate impact on the perceived value for executives. So this is a really interesting one for us, and one to keep monitoring. Our ISS's response to this appears to be relatively benign. They would note these are the changes, but they don't seem to be pushing back on it. And we always, as an sort of advisory style, will be to encourage companies looking at their policies to think holistically about all of those features. And do you need to just tick the box on every single one of them, or is there a more simplified approach that you might take, which says, look, we know we need to get executives to hold shares. That's fine, and everyone's comfortable with that. But are there ways we can do it which is more balanced, more sensible? So really interesting one to keep track of, keep monitoring. Okay, so then incentive opportunities. Now, again, this is another theme of the Big Tent. Are UK incentive opportunities uncompetitive? For some of the largest companies competing in global talent markets, and we have about 15% of the sample increasing their incentive opportunities, bonus or LTIP, LTI. So it could include restricted shares as well in there. Combination of those doing it via a new policy, particularly those with a big increase, but often some of the smaller increases are done within existing headroom within the policy. So the policy maximum will be higher than what the normal award level is, and they're now utilising some of that headroom to make higher awards. Most commonly, it's via the LTI rather than the bonus. Sometimes, as you can see in what the chart shows, is each individual company lettered at the bottom, and what their previous award level was, which is the sort of, don't even know what colour that is, but greenish, bluish bar, and then the grey bar is the new level, so the increment that they've moved up to. So you can see that most companies doing it via the LTI, some with the bonus, but often with the bonus combined with the LTI. a lot of the increases are in the range, sort of 25% of salary, 50% of salary, sort of relatively modest increases. And common rationale to explain these increases and give a narrative for them is around the strong performance of the business. And there is a market positioning aspect of this, that the company feels they need to increase to be a bit more competitive in their markets. Now, in those that are doing the smaller increases, 25, 50%, what we've seen so far in terms of ISS and in terms of shareholder votes where we've had them is a pretty benign response, pretty supportive so far. And what we look at now, we'll move on to look at, is the larger increases. So obviously there's a couple in there that are a bit more substantial than the 25 to 50% range. And what we thought we'd do is have a look at some of those almost brief case studies of some of the bigger, more prominent ones, which again are really core to the big tent idea, which is some of the bigger FTSE companies competing in global markets. Can they compete on remuneration and on incentive award levels against some of their peers? So we looked at 3 case studies, very prominent. I think you've seen these in the news, and we've looked at the ISS response to that on the basis that ISS, the most influential, the largest voting agency in the UK. And what we're trying to do is identify some themes about why some might be successful, why others might be less successful with ISS. This is a question we're getting, which is we'll try our best, but it's very challenging. It's a difficult thing for ISS to have to make judgments. There's a nuance to it. They're obviously looking at a broad range of factors around the proposition. So it's quite hard to distill it down into this kind of here are the 3 things, but we've done our best. We do think it is helpful, and we are getting questions on it. So if I just briefly step through them, obviously Smith and Nephew, what they wanted to do was a increase to the PSP, marginal increase to the PSP, and an introduction of RSUs as well. So moving to a hybrid, and the RSUs at 125. So on a PSP equivalent basis, if you unwind that with a normal 50% haircut, that's 250% of salary. There's 275% of salary increase. That's quite chunky. What did ISS say? Well, they didn't buy, according to our interpretation of what they've said, the performance story for Smith and Nephew. They also had a concern, as I mentioned earlier, around moving the quantum up at the same time as moving to a hybrid structure, which they think is not best practice in the UK. And it was interesting, actually, that the proposal wasn't even a standard RSU in the UK. It was a vesting over 1, 2, and 3 years. So it didn't even meet the RSP element, didn't meet the sort of UK standards. And then on the benchmarking and the positioning, they stated that they're looking for a lower quartile market positioning, which seems reasonable. But ISS were really pushed back on the fact that they hadn't disclosed enough around the benchmarking, the benchmark group, or enough to give ISS, enough to validate what they were saying. So ISS were against that one, and will await the AGM vote. Then we get to AstraZeneca. So obviously huge company, second biggest by market cap in the UK. They proposed a small increase to the bonus, big increase to the PSP, which would have taken it to 850, which would have been the biggest level in the UK. And ISS here bought the performance story. Clearly bought that story, recognized and acknowledged that it was the same, a UK structure, so staying within a bonus and a PSP, and that seemed to play well. But ultimately, and they disclosed the peer groups that they were using, but ultimately what ISS did is they sort of concluded that against a UK group, they modelled out the FTSE 10 and said, against this group, this looks too high for us. And it looked like sort of almost a very marginal judgment call by ISS to just go against on that one. And then you've got LSE, again, very prominent. We've all read about this one. Big increase to bonus, big increase to PSP, big increase to salary. Almost seems very, very challenging to get this one through. But ISS so bought the performance story and also the sort of turnaround of the business and the change and the transformation that's been undertaken at that company. Again, recognised helpful that we're staying bonus and PSP and not moving to something different like a hybrid. And ultimately, I think they really welcomed the disclosure of the peer group and all the benchmarking which supported the analysis, and made the judgment that that one would be a 4. So how do we analyse? What do we take away from all of that? I think I think number one, it's always been the case, if you have a strong performance context and performance backdrop, you're going to be in a better place than if you don't have that, if you're looking to increase incentives. I think, obviously, the UK structure seems to be helpful. It seems challenging to move to a hybrid or move to something unusual at the same time as trying to increase quantum. And it's probably technically better to, shift the structure whilst keeping neutral on quantum. That seems tactically and strategically an easier route to secure ISS support. And then the other thing is, I think, to try to disclose as much as you can around the market data, the benchmarking, the rationale. That seems to play quite well. But equally recognizing that ISS will seemingly ultimately just, even though you're doing that, still benchmark against their view of a UK group and take a view against a UK group. And it seems hard to move away from that. And I think finally, number 4, I think you do need to sort of keep your fingers crossed. It's really challenging. It's really challenging to see the difference between the AstraZeneca and the LSE group from an external perspective. And I should say, we're not involved in any of these companies, but from an external perspective, I think it's really difficult to see why one, and it probably is the case that it's a 51-49 in one case and a 49-51 ISS in the other case. That's our judgment on it. So it's challenging if you're trying to say, well, would we get away with this with ISS? It's just very, very difficult to say at those margins. And of course, finally, it's important to know how ISS will react about something. They are very influential, but our view, when we're advising, is you need to be doing the right thing for the business. You need to be talking to your shareholders about what the right proposal is, getting the support from your major shareholders, and ideally getting the ISS support. But if you can't, but you've got your major shareholders on side, that's what you need to be doing. So we don't want to be too influenced by what ISS are saying and how they are behaving. Okay, and so now we're on to outcomes. I'll hand over to Alex for this piece.
Okay, thanks, James. All right, so now I'm going to take you through some of the incentive outcomes that we've had for annual bonus, PSP, and then the impact on the single figure for the last year. So starting with the annual bonus, the takeaway there is that the outcomes are broadly unchanged year on year. Median bonus this year was 77% versus 78% last year. So not much of a change there. Most companies set their target annual bonus payout at half of max. So this is above that target level. Might suggest that companies think they're performing quite well for the last 2 years, but in general we see that bonuses pay above that 50% level. That's illustrated on the chart on the right there, where we've got each company as one bar, and the red dots companies which have had a decrease in bonus, green dots increase in bonus, and the grey is where we judge it to be broadly similar. So that's sort of if you're within a plus or minus 5%, and everything there is on percentage of maximum. And you can see there's pretty, there's about as many increasing as decreasing. So bonus, not much change. Now, discretion. This was a little bit more interesting when we digged into it. So we saw that 15% of companies exercised discretion. So they adjusted the bonus outcome after they determined, all the formula outcomes and, determined the financials and the non-financials. Now, around 40% of those were for poor financial performance. And so they calculated everything. Usually the financial element didn't pay out or something. They were left with a little bit of strategic performance, which they thought was okay. And then they just decided to wipe that out. And that was the case in most of the companies which had exercise discretion for poor financial. So most of those reduced it to 0. And then on safety performance, now that tends to be at oil and gas companies, manufacturing companies, and there the reductions typically a little bit less, something like 10% of the overall bonus outcome, 5 to 10, something in that range. And then finally, we saw one company use discretion to increase the bonus. Now, that was an interesting case because it's very rare to see companies increase the bonus. And, when we're advising, usually having talked to shareholders and seen their reactions, they only really like discretion to go in one direction, which is downwards. So to see it go up was interesting, but the circumstances which led to the increased bonus outcome was a war in Sudan. So that seems to be the level of exceptional event required to feel comfortable suggesting an increase to the bonus. The AGM outcome is still pending, so we will see what actually happens there. Now, James, can you take me to the next one?
Yeah.
All right, thanks. So here we have performance share plans. So here is a bit different to annual bonus. We actually saw quite a few companies increasing the payout this year. So 60% of companies had a higher performance share plan payout than last year. So you can see a lot more green dots on that chart on the right, and that resulted in a median vesting of 67% of maximum, which is up 8% versus last year. Now, that's a little bit above the long run average for PSPs, which tend to be more around 50%. So we can say that these are paying out a little bit better than normal, but that's following a few years of paying out worse than normal due to the impact of the pandemic and other market shocks. So then on discretion, now LTI is not as interesting as bonuses on this. It's quite rare to see that, and discretion used for PSP vesting outcomes. We only saw that for two companies. One was for windfall gains. That was a reduction at vest because they thought the share price was probably a little too low when they granted it. That's not the preferred approach nowadays. James talked about this a little bit later. They usually prefer to reduce at grant, but this is in a case of a reduction at vest. And then the final was when the other example of discretion was when EVA performance underpin was not met, and then a reduction was made, and the Remco decided what that reduction should be. So how did this all then feed in to the single figure? Well, that's on the next slide. And here you can see on this chart the percentage change in single figure from one year to the next. The green bars are obviously all the increases. The red ones are all the reductions. So you can see most CEOs, because of the CEO single figure, had an increase. And in fact, the median increase was 10%. That's a result of, slightly, a higher LTI vesting outcome, and also some of the salary increases from prior year as well. Looking at the extremes, why, for example, does a company have a plus 200% outcome or plus 150%? Well, that's a combination of not having a vesting outcome last year. Now you do have a vesting outcome. The LTI is a big part of the package, plus a share price increase from 3 years ago. And whereas the reductions of minus 50% on the other end are usually just going from, you had your bonus and your LTI to not having bonus and LTI. And so it's just your base salary. But there, so the main takeaway there is single figure is up 10%, but I'd say it's probably just a slight increase, as outcomes for CEO single figure can be quite variable, as you can see from the chart. So on to the next one. This is ESG. Now, I guess this is the same thing for the last few years, continued increase in ESG adoption. So the first thing isn't a really big story. We've got 80% of the sample have ESG in the annual bonus. That's not changed too much. And just before I go into here, there's a sort of cutoff point here in the presentation, in that up to this point, we've been talking about the first 100. And so we got our first 50 sample and updated it for the first 100 annual reports. And from here on in, we're talking about the first 50. So these are results from our first 50 DRRs. And we haven't updated that yet, but we'll be doing so, and we'll see where these go to. So this is the first 50. And comparing year on year, there hasn't been much of an increase on ESG adoption in the annual bonus because, well, it's already quite prevalent, and more than 80% have an ESG element in the bonus. And in the PSP, 60% now have an ESG element in the PSP, and that is quite a change. We have seen a continued increase in ESG adoption in performance share plans. But that is all really to be expected. And we thought, given that we know that's been the story for a while, let's look a little bit more into what are the actual outcomes of these ESG elements. And that's what we're showing on the chart on the right. So we're digging in here. This is for annual bonus, and we're digging into the annual bonus ESG element. The dark green line is what the ESG outcome was as a percentage of the maximum under that element, and the light green is what the percentage of maximum outcome was for the other elements. So we're just comparing what the performance outcomes are here between the two. And we were wondering, to answer the question that investors might often ask themselves, are financial measures tougher than non-financial, because they often suspect that non-financial measures are easier. So we tried to ask ourselves this question here, looking at ESG, and I guess looking at the bonus, there wasn't evidence that the ESG outcomes are actually easier than the non-ESG targets. So, and that you can see here on the far left, we've put together the ESG outcomes where they're above the non-ESG, and that was about 46%, and so that's only about half, and the other half were either about the same as the ESG, the ESG and non-ESG, and the other one is where we have the ESG outcome below the non-ESG. So not much evidence there of there being a difference in toughness of ESG targets and non-ESG targets. However, if we then move on to the PSP, on the next, sorry, James.
Sorry,
that's all right. If we move on to the PSP, now it's early days, a small sample, but we see that 67% of the companies on the far left there have their ESG outcome above the non-ESG. So that would suggest, based on this very small sample, that ESG targets might be slightly easier than non-ESG targets. Now, obviously a big sort of caveat around all of that, because this is only a few companies. So this is something we're just going to be keeping track of as time moves on. And actually, when we did this about 2 years ago for the bonus, we had actually a pretty similar picture. So where this will actually end up, I don't know, but it'll be easy. It'll be interesting to see. And then I think it's back over to you, James, for the next.
Yeah, thank you, Alex. I mean, I think this is great piece of analysis, this ESG stuff, because clearly, you're right, Alex, that everyone knows the story. Investors have been pushing for adoption. Adoption is up. I'll tell you the stats on that. What's probably more interesting is this angle now, because we have more companies with ESG having been adopted. We can start to look more at the outcomes, and particularly on the LTIP, because obviously an LTIP or PSP is a 3-year. So back 3 years ago, there weren't that many companies. So there's not going to be a huge sample this year of PSP vestings with ESG in, because it just wasn't that prevalent in PSPs that long ago. But we're going to start to get more data coming through on outcomes. And that's why we wanted to do this piece of analysis, because it's the classic skepticism that shareholders will have. And rightly so in many ways, because I think it is more challenging for committees to set ESG targets. They're not as used to it as they are with financial targets that have been around for as long as we've had executive pay. So it's sort of a journey into the unknown in many ways. But this is interesting in suggesting. I think very interesting, if I go back to this one, in suggesting that on the bonus, the market seems to be doing a pretty good job. There's a pretty good balance between those where the ESG outcome was a bit higher than the non-ESG, but equally, we have quite a few where the ESG outcome was lower, suggesting that the targets have been set pretty robustly. And that might be because the bonuses, we've had ESG in bonuses for more years now, so committees are becoming a bit more savvy, a bit more able to set robust targets. And the PSP is because this vesting, as I say, is from 3 years ago. Maybe they hadn't had as much experience in doing so. But I think this is something we will continue to monitor more broadly when we get more company disclosures, maybe later this year, because it's an interesting aspect of the ESG piece, instead of just looking about adoptions and looking about how are the targets set and how are the outcomes coming through. So there we go. Let's move on to windfall gains. And Alex mentioned this briefly. Clearly, this was a big issue last AGM season, when we had a lot of awards that had been granted in 2020 just following the COVID-induced decline in the market, so much lower share prices. And when they came through to vest last year, there was a lot of pressure, where you'd granted following a big share price decline, there was a lot of pressure at vesting to make an adjustment. The shareholder guidance has evolved a bit since COVID, and now there's a clear preference that if you're in a situation where your share price has dropped significantly over since the prior grant, the grant in the prior year, you would get a larger number of shares. So in order to prevent that a windfall occurring, if you get a large number of shares and then there's an uptick in the share price, what the shareholders want you to do is to make an adjustment at grant. And what was interesting in our sample, again, this is, as Alex said, this is the first 50, so we haven't expanded this to the first 100. But in all the cases of the grants that were made by those companies during the reporting year, so during 2023, there wasn't one company that made an adjustment to the grant level at grant to reflect a windfall gains risk. And that included, in that sample, this list of companies we've shown on the right, which had fairly material share price declines. The threshold at which you start to think about, well, how far have we fallen and how far has the share price fallen? Do we need to make an adjustment? There isn't a clear market guidance on that. LGIM say it's 20%. I think most investors are probably looking more like 30, 40% before they start to get exercised around whether you should make an adjustment. But none of these companies made an adjustment, which is, really interesting to see. And it doesn't appear so far that ISS is making this a voting issue for these companies. So just one to be aware of, if you're in this situation and the share price has fallen, you think, well, do we need to make an adjustment? Not that many companies so far this season have been doing it. What we have got is in the DRRs, there were a couple that flagged that for the year ahead, they were going to be making an adjustment. So clearly the issue hasn't gone away, but just interesting to note that no companies did it during 2023. Okay, and finally, last but not least, we have the chair and the NED fees. What we've got here is the chart on the left-hand side shows the alignment of, well, first of all, let's say 78% of the first 50 increased chair on NED fees. That's 4/5 of the market is doing an annual review. That's quite interesting because I think, and what we've said in our NED report from last October, is that we think that the frequency of NED reviews is becoming more common. So it used to be, the case that you would review every maybe 2 years or 3 years. We think now it's much more common to review on an annual basis. What the pie charts show is the alignment between the NED fee and the chair fee increase and the all-employee rate. And that shows a slightly more balanced picture than for the executive directors, where discounting is, as we showed earlier, discounting remains the most common approach. But still, there are quite a number here. So the ones that in the orange, the below workforce, quite a large proportion are discounting NED fees and chair fees to the all-employee rate, which we think is, we don't think there's the same pressure to do that than there is on the executive side. And it's one to just be cautious about, in the sense that if you do that for too long with your non-execs in your chair, you'll start to fall below a reasonable market rate. And that's what we showed, that NED fees and chair fees had fallen, way below the inflationary rate over the last 10 years, because this sort of creep into the way that they are set in the trying to sort of discount them for the all-employee rate. So be slightly wary about that. And then the chart on the right just shows the absolute levels of increase. It's very similar to the executive directors, around about 4% to 5%. That's what we're seeing. So that brings us to the end of the presentation. I appreciate there was a lot in there. Do we have any questions, Alex? You're on mute.
All right, so that will help. Excellent. All right, so first question here is, so it is interesting that ISS's view seems to be that increased quantum, or introducing an RSP, is acceptable as a reward for past performance. for example, AstraZeneca, right? But not as a mechanism for incentivizing executives to deliver high future performance, as in Smith and Nephew, right? Because Smith and Nephew, yeah, they had sort of mediocre performance, right? And how do you get, how do you then use it as an incentive? So the question then is, have there been any companies that have successfully put in place a hybrid scheme or increased quantum without a history of strong performance? And I guess it's different here, is it? Like who's, well, and when we say successfully, because there are different levels of success, right? The ISS recommendation is one part of that. Your actual final vote is another part of that, right? And we know of one other company that's put in a hybrid scheme, right? And
yeah, I mean, I actually I think it's a really good point, because I think it's odd to say that you need to have strong past performance in order to put in an incentive to generate future performance. I agree with that, but that does appear to be the way that ISS will assess this. They want to see strong performance as a context before you do it. I mean, yes, I think there are examples of companies that, for example, if you're in a what you might call a sort of turnaround situation, where the share price is really falling off and you need to put something in place to secure a new management team, or to motivate the team to turn around the business, that I think there are historic examples of doing that. And I think you clearly need to be able to make a really compelling commercial case to ISS, and or just accept that ISS aren't going to be supportive. As I mentioned earlier, I think this is increasingly what I have seen over the last 2 or 3 years, is it's just challenging to bring ISS along on all the time on commercial arguments. And so committees are more willing to say, as long as we've got our real shareholders on side, our large shareholders, the ones that have material holdings that will talk to us, that have a big enough holding to engage, and obviously try to expand that as far as you can down the register, as far as feasible. But if you've got those institutions supportive, or the majority of them, or a comfortable majority of them supportive, companies are just more willing to just take the ISS on the chin, and then try to mitigate the impact of the ISS, trying to do what you can within the tail of your register, and with those who are mandated to follow ISS, try and do what you can. But it's challenging. And I think, yes, there was one other example. There's been 2 examples this season of moving to the hybrid, but both of them also increased quantum, and ISS has been against. And it's, as I say, I think our reading of it is, it's the quantum increase at the same time as moving to a hybrid, which is the challenge. What would be helpful is to have some hybrid proposals without increasing quantum, and then we can isolate that. And hopefully, I hope that ISS would be supportive of those. I think my reading is that they would be. It's not the structural issue; it's the fact that it's changing the structure, and also at the same time increasing quantum. I mean, there was a new hybrid that was introduced last year, just prior to the cutoff for our report, so it's not included, but it was a FTSE 100 company at the time that had moved to a hybrid and got ISS support. So we had been thinking that, and again, there was no quantum increase at that stage. So I think it's too early to say exactly how they'll land on hybrids, but I think probably hopeful that if there's no material quantum increase at the same time, it's something that they should hopefully get supported on.
In the Smith and Nephew example, I thought it was interesting that they really drilled down into the retention argument that Smith and Nephew were trying to make. They said, we can't really recruit, we're having trouble retaining CEOs. And then in the report, they actually looked to see where the CEOs had then gone to, and then made an assessment based on that, which I hadn't seen them do before.
Yes.
But there you go. All right. Well, that's the only question we have in the Q&A at the moment. I'll just check the chat. So nothing there. So
okay. Well, how are we doing? Well, we'll give you back 13 minutes then of your morning. It's great having you here today. Thanks for joining. as I said, we will circulate a recording, we will circulate the slides, and we look forward to seeing you next time. Have a good day. Thank you.